In this video, we're going to have a look at the gross income definition for residents and how amounts are included in gross income. Now, the taxable framework starts off with the term gross income. Remember, I said to you in the taxable income framework video that amounts can be included in gross income in two ways, either through the definition of gross income or through a specific inclusion. In this video, we're going to have a look at the definition of gross income. Now, there's 4 requirements for a resident, as defined in Section 1 of the Act. The first requirement is that it's a total amount in cash or otherwise. Secondly, it must be received by or accrued to or in favor of the taxpayer for the current year of assessment, so we're looking at specific dates, and not of a capital nature. And all these requirements need to be met for an amount to be included in a taxpayer's gross income. Let's have a look at what each of these terms mean broadly. You will need to go and have a look at it more closely, but just an idea of how we would apply the requirements to an amount. So first of all, it's a total amount. So that means there must be an actual amount for it to be included in gross income. And it stands to reason that this can be in cash or otherwise. So it's not only money that's included, but also the value of every form of property that's earned by the taxpayer. So if the taxpayer receives something like an asset that's other than cash, then the market value of that asset will be included in their gross income, and it'll be the market value on the day that it was received or accrued to them. That's the next requirement, that it's receipt or accrual. These will generally coincide. So for example, a cash sale, the sale accrues to the taxpayer on the day that the amount is received. But it is possible to receive an amount before it accrues, or for an amount to accrue before it is received. For example, credit sales. The sale accrues on the day the sale takes place, where there's a legal liability, and then the amount is received later. This is only a problem for gross income and which year to include it in if the transaction takes place over the end of a tax year, because then we've got to decide in which year the amount will be reflected as gross income. Remember that we've got to use the earlier of receipt or accrual for tax purposes. Accrues to has got a specific meaning. The court cases and cases in law have decided that it means become unconditionally entitled to. So once a taxpayer becomes unconditionally entitled to an amount, it accrues to them and must be included in their gross income. In favor of, which is also part of this requirement, means that income that is received by another person on behalf of a taxpayer, the taxpayer will have it included in their gross income, irrespective of how they apply the amount after it accrues to them. So if someone, for example, an estate agent receives rent on behalf of a taxpayer from a lessee, then that rent will still be included in the taxpayer's gross income because the estate agent is only receiving it on behalf of the taxpayer. Obviously, the year of assessment is the current year of assessment that you're looking at. Every individual's year of assessment runs from the 1st of March until the end of February. And when you're looking at an amount, whether you're looking at whether it was received or accrued, you need to look, does it fall within the year of assessment that you are considering for that taxpayer? And then the last requirement is no amounts of a capital nature are included in gross income in the definition. There might be some specific inclusions, we'll look at that in another video, but for the definition, if the amounts of a capital nature, it's excluded from gross income and will probably end up being taxed in terms of capital gains tax or, as I said, a special inclusion. So in this case, we need to look whether the sale or the income is from the sale of a capital asset or just the realization or disposal of an asset in a profit-making scheme. Unfortunately, not all decisions are clear-cut depending on the taxpayer and the transaction. And so the courts have looked at intention of the taxpayer to decide whether the amount will be included in gross income or not. And remember, this is done on the balance of facts. So you've got to look at a lot of the situation before you can make a decision. You can't just say, oh, the taxpayer said they're selling it for a profit, therefore it's revenue nature. So intention, we look at what is the intention, what does the taxpayer want to do with the asset? Are they selling it for a profit, or have they held it for a long time as an investment and now they're selling it? If they keep selling it at a profit, then it will probably be of a revenue nature and included in gross income. Or if the asset's been held as an investment, then the chances are it will be a capital of nature and not included in gross income. Let's look, for example, at a house. One taxpayer might buy a house to hold it for an investment and rent it out. They'll be taxed on the rent, and when they sell the house, it'll probably be a capital of nature sale and not included in gross income. Whereas someone who buys and sells houses all the time to make profit on them, their sale of the house would be of a revenue nature, and that sale would be included in gross income. Intention, we look at it at 3 stages during the holding of the asset. At the time of the acquisition, so when the taxpayer purchased the asset, what was his intention to do with it? During the holding of the asset, because they might change their intention during the time that they're holding it. And then again, we look at intention at disposal, and based on that balance of facts, try and decide whether an asset or the sale of an asset is revenue of nature or capital of nature. Remember, capital will exclude it from being included in gross. So the test of intention is subjective in nature and open to interpretation. And so the courts have also got a list, and this isn't all of them, of objective tests where we can look at the facts of the case. Now remember, it's not just a list of a tick box. Each one of these facts gives us an indication of whether the asset has been sold in terms of a capital asset or whether the sale is of a revenue nature. So we look at things like the nature of business or occupation. If a person's buying and selling houses all the time, then obviously the sale of a house should be revenue of nature. We look at the frequency of similar transactions, the conduct of the taxpayer in relation to this specific transaction, continued activities, length of time that the asset was held. If it's held for a long time, it could be indicative of a capital asset. We will also have a look at the documentary evidence, the history of the taxpayer's holding of the asset. How many times have they declined an offer on it? Have they thought about selling it before? We'll look at the circumstances around the realization or the sale of the asset. A good indication in practice is often the accounting treatment of the proceeds, because the taxpayer will treat it one way for accounting purposes and say for tax purposes perhaps that it's capital of nature. And then we'll also look at the taxpayer's financial resources to see if their resources can support what they say their intention is. So these are all factual tests that will be looked at in practice to try and substantiate the intention or what the taxpayer says they're going to do with the asset. So in terms of intention, we've said we're going to look at it at the acquisition, during the holding of the asset, and at the disposal. Also, there could be mixed intentions of the taxpayer. They could have dual intentions, and then we'll look at the predominant one. And also, perhaps there's a change of intention. Now, all of this is quite a grey area in practice, so there's been quite a lot of court cases around this. But in terms of looking at someone's taxable income and seeing if an amount's going to be included in gross income specifically, the information that you get, you can weigh up and get a definite feeling for whether an amount is of a capital nature or not. And remember, if you decide it's of a capital nature, it won't be included in gross income. I've included 2 examples in the slides, have a look at each of them and see if you can decide based on all the requirements of gross income whether the amounts in question will be included in the taxpayer's gross income for the current year of assessment. So that's the 2020 year of assessment ending on the 29th of February 2020. So that's the first example. And the second example is the same. Use the information, look at all the requirements of gross income and decide whether the amount in question will be included in the taxpayer's gross income. In the next video, then we'll work through it together to see how we apply the requirements of the definition of gross income for a resident.